Well, the bar had been set low for earnings this season, but Wall Street's worst fears don't seem to be playing out, at least not yet. Bob Pisani explains.
It's early, but there are signs that earnings might be better than everyone thought they would be. Earnings anxiety has been running high recently because analysts have been expecting an improvement in the U.S. economy and an improvement in earnings in the second half of the year. But the whole Brexit vote has made a lot of traders nervous that big multinationals like General Electric might use the Brexit vote as an excuse to talk down earnings for the second half of the year. But so far, that hasn't happened. All the major U.S. banks have reported, and all of them have beaten estimates. In fact, Goldman Sachs, Bank of America, and Citigroup had significant beats. So those strong bank earnings have lifted second quarter earnings estimates for the S&P 500 overall. Earnings are still expected to be down about 5%, but that's better than it was last week. And early reports from other sectors have been better than expected as well. So what the market really cares about is guidance for the second half of the year, and there are hopeful signs here as well. This morning, Johnson & Johnson and Lockheed Martin both raised sales and earnings guidance for the full year. Lockheed cited exceptional operational and financial results as the reason for raising their guidance. So the bottom line is only 11% of the S&P is reported so far, but the early signs have been encouraging, and that is one reason the markets are holding up so well. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.